Hello everyone, welcome back. This is the large cap portfolio update for week 8 of fall term 2022. Our current value is 3.51 million. And here's our weekly performance overview. So we had a weekly return of negative 17 basis points versus the S&P of negative 25. So we generated some good alpha there. Our year-to-date return is still negative, along with the S&P. We're just slightly below. Last week, it was our first week that we were beating the S&P on a year-to-date basis. Our year-to-date alpha is negative 1.66%, so we are getting closer to zero. And hopefully by next week, if our stocks in our basket perform well comparative to the S&P, we'll actually be up on the year to date and have some positive alpha. So our 1-year beta remains relatively unchanged. We moved up a little bit, so our basket of stocks is becoming a little bit more volatile relative to the market. We're still below the beta of 1, which is the market, and our 1-year Sharpe ratio is getting closer to the S&P 500. But since it is below the S&P 500, we are still being undercompensated for the risk that we're taking. But nonetheless, our inception return, so since the fund was started in 2007, we are still beating the S&P by a small margin. Hopefully by the end of this year, we'll be able to grow that if we see a tech rebound or we see any sort of equity rebound. We had 1.11% alpha last week. This was one of our best weeks this year. Last week was. We had no dividends in trades this week. We had $2,000, so $2,000 in dividends from Blackstone and Costco last week. Our underperformance, or actually, this is a typo, but our outperformance this week was attributable to Axon absolutely, crushing earnings and beating estimates by a huge margin. And we're still underweight technology, so that kind of saved us. Moving on to U.S. Treasury yield curve and economic data. Yield curve is still relatively flat, but we're seeing the yields of long-term maturities, 1 year plus, come down versus where they were last month. As you can see, the orange line versus the black line. The delta was the highest for the shorter term maturities, and it's really starting to flatten out. It's still humped, which is a little concerning, but long-term yields fell. This is good for equities. The Fed will not stop raising despite new inflation data, so expect another 75 basis point raise. I put an article in our group's Slack, which I'll paste down below in the description. It was an article written by the Fed of St. Louis in 2005. Just kind of goes over what Volcker did during his time to kind of rein in inflation. It's a great read. It's a quick one, but a lot of insight there. Basically, the summary of the article is, despite inflation, coming down relatively quickly, they kept rates high to kind of squash it, and they engineered basically 2 brief but intense recessions to kind of rein in inflation, and they got it under control. And his actions directly led to kind of the prosperous economic growth we saw in the 80s and 90s. There is still real opportunity cost of holding dollars right now. So investors from 2010 to 2019 had little to no opportunity cost because bonds and the risk-free rate yielded little. So when we think about opportunity cost, it is the next best opportunity that we give up when we make a decision. So from 2010 to 2019, there was opportunity cost, but it was not high. It was not great. Versus it was not where it is today, because the risk-free rate was around half a percentage point to 1 percentage point, and then when we got into some small rate hikes in 2019, we saw kind of that opportunity cost raise a little bit. And then when they cut during the pandemic, there was no opportunity cost. You saw tech have an explosive rally. There's a lot of froth. And now you're seeing the risk-free rate rise, so investors are going, hey, I could put dollars into, this skeptical company. And back in, 2017, that was, a good opportunity for them. because the next best choice was, hey, I can buy bonds or risk-free rate and basically just keep up with inflation. We're now in a scenario where investors, with dollars, they go to the equity markets and they look around, and they have some good opportunities right now relative to earnings, but you go to the bond market, the debts market, or the buying directly treasury US treasuries, and there is opportunity cost there because they could be making 3.5% from buying a 1 month treasury, almost 4%. So it's always good to keep in mind what investors are thinking when they go to these different markets, and just kind of being cautious of your opportunity cost when you're doing your own investing or decision making. Again, this basically entices investors to make long-term investments in companies which produce jobs and economic growth in the future when the opportunity cost is low. Again, you saw that kind of the tech explosion, the tech rally from 2010 to 2019 and so on. And you're seeing kind of that come into focus now, and tech is entering basically a recession in its own little sector. You see Amazon cutting jobs, Meta cutting jobs, and these were kind of the Titan companies that were hiring whoever applied. They were really doing a lot of hiring. I think last year Amazon hired 800,000 people. Most of those were warehouse workers, but it still kind of illustrates that the emphasis was on growth. And I'll go into kind of cash flows in the next slides. But the emphasis now for investors is, hey, is your company profitable? If not, it's getting discounted. If it is and it has positive free cash flow, then you're going to receive a premium because it's a safer bet rather than a company that's just burning cash right now. And back in 2010 to 2019, it was okay for these tech companies to just burn cash. They were focused on growing their users so they could be profitable in the future. And now that emphasis is kind of just totally reversed. And it's interesting to watch market sentiment throughout the world change so rapidly. So keep your eye out for that. So investors want free cash flow, and they want it now. Here are two examples of cash flows from different companies, two very different companies. One had sold off this year despite its growth in its business, and the other one is rewarded for its growth in its business. The one that was rewarded was Ulta. This is basically a beauty and cosmetics distributor, and it made the right decisions. It grew its free cash flow. As you can see, from 2021 to 2022, it has growing free cash flow. Its operating cash flows are growing. Versus Amazon, look at that free cash flow in 2020 when it was riding high, and it was near its all-time high ever. It had positive free cash flow. And now going into kind of this next segment in this next couple of years, management has made a lot of capital investments. They've built out a lot. And some might even say they've overbuilt. That's going to raise, the cost of, them being able to do business. And as a result, their stock has, basically gotten cut in half from a year ago today. So it just goes to show, be looking out for companies with free cash flow. They're going to get a premium. They're going to be, demanded from investors, and these other companies that are not free cash flow positive, they're going to get sold off. Investors don't want that. So just keep your eye out for that. Another kind of interesting point of view that I have is the Fed is raising, the opportunity cost for investors by raising the risk-free rate. And it's basically forcing companies, hey, if you don't want your stock to get cut in half, you better be free cash flow positive, and you better be, growing that free cash flow to your firm, so that investors, will reward your company's price. So what does that do? It basically forces companies, if you look at how free cash flow is calculated, it's your operating, cash flows minus any capex or investments that you do. And so it either puts companies in a position where they can, try really hard to raise their operating cash flows or cut back on investments. And when you look at when companies spend, and you get the basic idea that another person's expense is another person's income, companies are going to start bringing in their investments. They're going to start cutting back on them. They don't want their stock getting cut in half. They want to be free cash flow positive. That's what's popular right now. And until the Fed starts cutting rates, that will be the emphasis. So we definitely will be going into a recession, is my prediction, because companies and senior management are going to be forced to cut their investments. And one person's investment, building out a building is, creates jobs. So until you see kind of companies cut their investments, cut their capex, and you see a decrease in, job growth, and you see kind of the unemployment rate, unfortunately, it has to come up to rein in inflation. Until you see that, you're gonna get rapid inflation, and you're gonna get kind of, where we're kind of stuck in this tug and pull with inflation, tug and pull with, capital expenditures. And until that, those numbers kind of align with where the Fed wants them, they're not going to cut rates. They're going to keep rising, just like what Volcker did. And in Volcker's time, there were wanted posters out for him. People wanted to hurt him. They wanted to, have him, cut rates, and it was very painful. But what he did was, he reined in inflation. And if you look at the fall of Rome, the basis of their, kind of fall, from grace wasn't, rapid hyperinflation. And since the beginning of time, whenever you have a fiat currency, it's always hyperinflated. So maybe this time's different, maybe it's not. But until the Fed can rein in inflation, expect those big basis point raises from the Fed for the risk-free rate. Expect rate hikes. Expect there to be a downturn in, economic activity and capex from companies. Moving on to Axon. Axon reported earnings, and they absolutely crushed, which is interesting because they're not, they don't have positive earnings yet. They're growing it. But last year they had negative earnings, and you've seen kind of this emphasis from management to kind of cut back investing. We need good earnings, or else our stock's going to get sold off. And so this company is up 21.16% year to date as of today. And so it's really kind of interesting to see. They have growing revenue, they're cutting expenses. So while they're having over 10% increase in revenue, they're having actually a reduction in expenses. They're trying to make their organization, their firm, more lean, more flexible by spending less money, which I think is a reward for shareholders, because you're going to get growing free cash flows. Unfortunately, right now they have a reduction in free cash flow, but they also have growing EBITDA, growing earnings, etc. They're also shrinking their total expenses and their stock-based compensation, which is really awesome to see. So investors are kind of weighing this, and I might look to take some gains in the stock. The stock is almost at $160,000 of our $3.5 million portfolio. So I may look to kind of shave down this position. It's in the industrials category, and we're right at market weight with the S&P. So I may look to kind of reallocate some capital from this company and maybe buy a little bit more Lockheed Martin or Honeywell. I got to do some more research, but those are moves that I'm considering. So just real quick, synopsis of Axon. Axon makes and develops body cams and body cam technology for LA agencies, law enforcement. They also produce tasers and other non-lethal weapons for these agencies. And in addition to the surface level products, the company has a cloud business where law enforcement agencies pay a monthly fee or subscription revenue service or software as a service to store body cam footage and data on the Axon cloud. So this kind of is a great business for Axon. When law enforcement agencies are looking to buy new gear, they have that point of sale, that one-time sale, but it's like, do you want to store the data for the gear? Do you want to store the footage? We have the Axon cloud. It's another add-on service that creates kind of this recurring customer. And I think that's why it's receiving a premium in the market, despite not being necessarily earnings positive right now. They are free cash flow positive, which is good. But again, they're moving in the right direction, and a lot of these factors, they're showing that Axon is a premium, deserving company. This service produces Axon company with subscription revenue, as well as a one-time sale. Management at Axon is also growing earnings while maintaining positive free cash flow to firm, which is great. So companies like Axon, while they continue to outperform and receive upward earnings estimates from analysts, they're gonna, get bumps from investors for their stock price. So you're gonna see, rapid growth. And, I think a little bit of this this massive, rush to buy Axon stock is a little over-deserved, and I probably will take some gains. I think this is still a solid company, and it belongs in our portfolio of quality investments. So as always, thank you for tuning in, and I will see you next week.